Okay, let's dive into this. We hear from you all the time, looking for those stocks that, kind of hit that sweet spot, decent growth and some income.
Yeah, it's tough. You often find either like really slow growers with a small dividend or these super high growth names that pay nothing back.
Exactly. You're looking for something, well, different, some that really pops.
Something where the income actually keeps pace, maybe even outpaces the company's growth itself. That compounding effect.
Precisely. And that's why the source material caught our eye. It uses some pretty bold language about one specific company, calling it a high-growth dividend unicorn. We're talking about Broadcom, ticker AVGO.
Unicorn, yeah, because finding strong growth and really fast-growing dividends together, especially in a big company, it's rare.
So that's our mission for this deep dive. Figure out why the source is so bullish. What makes Broadcom a supposed unicorn, according to this analysis? What are the key facts they present?
And importantly, what risks do they point out? We're basically trying to understand their high-conviction view by digging into their arguments.
Okay, let's start with the dividend facts, but maybe not dwell just on the starting yield.
Right. So the source says the current quarterly payout is $5.25 a share. That works out to $21 per year.
$21 a year. Now, the source mentions the stock price is around, what, $1,400 recently?
Yeah, somewhere around
They're
that.
doing the math. That's a yield of like 1.5%, which, honestly, doesn't immediately sound like a typical income play.
No, if you're comparing it to, say, utilities or some consumer staples, it looks low up front.
But that's exactly the point the source makes right away. It's not about the 1.5% now. It's about how fast that dividend is growing.
That's the core of the unicorn argument, according to them, the growth rate.
And this is where the source drops a pretty dramatic number. They talk about the compound annual growth rate, the CAGR of the dividend over the past decade.
Get this. 36%.
Wow.
36 freaking percent is how the source puts it. That's not just steady growth. It's like a rocket ship. Financial rocket fuel, they call it.
That completely reframes that initial 1.5%, doesn't it? They give this great example. If you bought the stock 5 years ago,
Yeah.
your stock value's up maybe 4 times over, something like that. But the actual cash dividend hitting your account today, it's nearly 5 times bigger than it was back then.
Now that shows you the power of compounding that dividend growth. It's not just the stock price appreciation.
So how does a company fund that kind of, aggressive dividend hiking?
It comes down to cash flow. Free cash flow, FCF. The source is really big on this.
They say Broadcom generates cash flow that won't quit. What are the numbers?
Currently, the source states it's around $18 billion in free cash flow annually.
$18 billion, okay.
And they emphasize how that cash gets used. For fiscal 24, the source says over half of that FCF went straight back to shareholders as dividends.
Over half. Wow.
Plus, they're doing significant share buybacks on top of that.
Yep.
That's why the source calls them shareholder first.
And they're still projecting growth in that FCF number.
Yeah, the source points to forecasts of like 20% plus growth in FCF over the next couple of years. That's the fuel they think keeps the dividend engine running hot.
Okay, so that's the income side. What about the growth part of the unicorn? Double-digit revenue growth.
Right, even at their current size, which is roughly $40 billion in annual revenue. That's a pretty impressive scale to still be growing that fast.
Like trying to get a freight train to sprint, as the source kind of puts it. What's driving that?
According to this analysis, it's a few key things. Huge demand for AI data center components, the stuff that makes AI work.
The plumbing for AI.
Exactly. Also, custom chips, ASICs for the big cloud players, think Google, Amazon, Meta, the source names them.
And the software piece?
Yeah, that's a big one now, especially with VMware integrated. Enterprise software growth is a major driver.
Put it all together, and the source suggests they could hit, $60 billion in revenue by fiscal 2026?
That's the target they mentioned, yeah, $60 billion.
Let's talk about that VMware deal. $69 billion. That's huge. The source mentions Wall Street was not exactly thrilled at first.
No, definitely skeptical. You heard things like, they're chip guys, not software guys. Or, blogs saying way too expensive.
So how does the source see it now, looking back from 2025?
They paint a very different picture. They call VMware a recurring revenue juggernaut, now under Broadcom's management. They've apparently streamlined things, improved margins.
And there's a specific number they expect from it.
Yeah, they quote an expected EBITDA contribution from VMware of about $8.5 billion by 2026.
$8.5 billion, that's significant.
It really is. And it fundamentally shifted the business mix. The source highlights that software and subscriptions are now roughly half of Broadcom's revenue.
Which means More predictability, less of the
Yeah.
chip cycle swings. Yeah.
Exactly. More predictable, smoother cash flow, as the source puts it. And that kind of reliable cash flow is, well, perfect for supporting those big dividend increases we talked about.
Makes sense. And besides dividends, the source also mentions buybacks again.
Right, just reinforces that shareholder return angle. They've apparently bought back tens of billions in stock recently.
Which shrinks the share count, helps earnings per share. It all fits that shareholder first narrative the source is pushing.
Okay, but let's address the elephant in the room. Or maybe the question you, the listener, might be yelling at us right now.
Which is...
Is it super expensive? The source brings this up, acknowledges the trailing PE is around 30.
Yeah, 30 times earnings sounds kind of high.
But they argue that's looking backward. They point to forward numbers, like around 23 times forward earnings and maybe 18 times forward free cash flow.
Okay, that sounds a bit more reasonable.
And they mention the PEG ratio, price earnings growth, is about 1.2. The source describes that as pretty fair given the growth rate and, importantly, relatively low debt.
And they contrast this with, what was it?
Yeah, they kind of poke fun at paying 50x earnings for loss-making AI startups run by tech bros.
Yeah.
Their point is, Broadcom's delivering real, like 15, 20% annual earnings growth based on its actual business, not, quote, meme hype.
All right, so the valuation might be more reasonable than it first appears, according to this analysis. What about validation? Does the source mention who actually owns this stock?
They do. And it's an interesting list. Seems to cut across different investment styles.
Hey, cool.
They mentioned the Vanguard Dividend Growth Fund.
Right.
Makes sense. But also T. Rowe Price Blue Chip Growth Fund.
Oh, okay. Growth and dividend growth investors.
Exactly. And BlackRock's income ETFs are in there. Plus, they name-drop Bill Nygren from Oakmark, a well-known value investor.
So the source sees this as a sign that both growth and income folks agree on this one.
Yeah, they make a joke about it being rarer than bipartisan cooperation in Congress. It's a key part of their unicorn thesis, this broad appeal.
But it can't all be smooth sailing. Surely there are risks. Does the source address those?
Oh, yeah, they have a whole what could go wrong section. They're pretty upfront about it.
What's on the list?
Well, first, the obvious one. Semiconductor cyclicality. Chips go up, chips go down. If AI demand cools off or the big cloud companies tap the brakes on spending, that could hurt.
Makes sense. What else?
Regulatory risk. Broadcom's a big acquirer, aggressive M&A. That always attracts scrutiny.
Okay.
Then there's execution risk on VMware. Integrating such a huge acquisition is complex. If it goes sideways, as they put it, or doesn't deliver the expected cost savings or revenue synergies, that's a problem.
Right. The $8.5 billion EBITDA target relies on good execution.
Exactly. And finally, they mentioned interest rates. Just basic math. If interest rates stay really high, that starting 1.5% yield just looks less appealing compared to safer options, even with the growth. They frame it as maybe more of a short-term perception issue, though.
So standard risks for a company like this, but definitely things to watch.
Absolutely. And the source kind of frames it like this. Look, if you want zero risk, you buy a treasury bond and get a low fixed yield. Broadcom, they argue, is for investors who accept some risk for the potential to beat inflation significantly through both share price growth and that rapidly growing dividend.
Okay, so boiling it all down, why does this source have such high conviction? Why call it a unicorn?
Their core argument seems to be, it's profitable, it's growing fast, even at a huge size. And management is clearly focused on sending cash back to shareholders via dividends and buybacks.
Oh, and it's tied to real infrastructure trends.
Right. They see it as providing the essential building blocks, chips, and software for massive trends like AI and cloud. It's not just some speculative fever dream app, it's the underlying stuff. That combination of growth and income potential without what they call vanity preacher nonsense is why they're so bullish. The dividend isn't just a payout, it's a signal of strength and discipline.
So, bringing it back to you, the listener, if you're looking for income that actually grows, maybe significantly, if you buy into the long-term story for AI and cloud infrastructure, and if you like companies that actively return capital, then this source makes a pretty compelling case that Broadcom might be one of those rare finds where fundamentals, growth, and shareholder returns line up.
It's definitely an argument built on numbers and strategic moves, according to this analysis, not just, wishful thinking.
And of course, we have to reiterate what the source itself says. This is their analysis, their perspective. It's information, not investment advice. Do your own homework.
Absolutely critical.
But it leaves us with a final thought, sparked by this deep dive into the source's view. If Broadcom is a rare blend because it provides that essential infrastructure for big tech trends rather than just the surface level stuff, Well, what does that tell you about where else you might look for similar opportunities? Does focusing on the plumbing change how you might think about building a portfolio that aims for both growth and growing income over the long haul? Something to chew on.